Hello everyone, this is Jimmy Singh, broker owner of Supermax Realty. Welcome to my channel Real Estate Edge with Jimmy Singh. In today's short video, friends, I like to answer one of the questions put forward by one of the audience through my channel. And he asked me that he recently acquired a residential property as a primary residence, and his wife intend to run a salon from the basement, and he want to rent a couple of rooms in the house for students. So he just asked me what are the tax implications if I am aware of any. So friends, as everybody knows, I'm real estate broker owner. I'm not tax accountant by any stretch. So if you want tax or legal advice, kindly seek help of the professionals. But in this video, I will just share my thoughts how CRA, which is Canadian Revenue Agency, considers your primary residence exemption if you change the use of the property. So as we all know, in Canada, the biggest benefit everybody has is there's no tax on your primary residence. If you live there for like 5 years, 10 years, whatever money you make, there's no taxes on it. But if you use as a rental property, there are capital gain tax and all other sort of situations. So according to CRA, there is three factors they consider thinking that you have changed your house use to rental, whatever the portion is. The first consideration for CRA is what is the business use or a rental use versus your primary residence use. Meaning, what portion of the house are you using? 25% of the house, maybe you're using your basement for your business, or you're using half of the house or more than that. So if you're certainly using more than half of your house to generate income or renting your basement and upstairs as well, there can be tax consequences on that portion. Second thing CRA checks is, are you making any structural changes in your property to make it suitable for rental or business purposes? That is the second consideration CRA has. Third consideration CRA looks forward is, are you deducting CCA, which is capital cost allowance? So folks, in real estate, land goes up in value, buildings over the period wear and tear, they depreciate. So in accounting term, they have kind of schedule where they look how much you can depreciate every year. So some high net worth clients, high income clients, or sometime depending how you structure your portfolio, did you buy property in corporation or is it in your name and you are making lot of income, high income tax bracket in Canada. So what some accountants I know they recommend is to write off the capital cost allowance against the income for that year. So what you're basically doing is you're deferring paying more money now, but when you sell the property in future, you have to claim all these cost down the line. So all in all, you have to consider two things. When you sell the property, maybe the CRA will say within the reason you have to split which is exempt portion, on which portion of the property you have to pay capital gains. So if you're using, let's say, 50% of the property to run a business, or you're using as a rental basement apartment, chances are they will consider that as capital gains. The rest can be exempted, and certainly your accountant can help some forms or schedules to get over it. Second thing is, you have to always report capital gains on the rental portion of your property. Keep that in mind. So if you're renting your basement, folks, in a house, and you consider the area of the house, maybe upstairs, if you're renting to students, if it is greater than 50%, there is a chance CRA might challenge your exemption when the time comes to sell your primary residence, and they might say 100% is not exempt your profits as a primary residence. You still have to pay some capital gain. Again, this video is for general information only. If you want further information on all the tax implications, kindly seek professional legal or accounting advice. Thanks for watching. Hope it helps. Bye bye.